Hey, what is going on, everybody? My name is Andy Wilson, and welcome to Twisted Finances. Today, we are going to be talking about what a balance sheet is. So, a balance sheet is a financial statement that a company furnishes that shows its assets, liabilities, and shareholders' equity at a specific point in time. So, balance sheets are essentially a snapshot of a company's financial position at the end of the month, quarter, or year. If you wanted to compare a company's balance sheets from year to year or month to month or quarter to quarter, it's best to do it from that month. So if you looked at April of 2020, you want to look at April of 2019. Comparing a company's balance sheets from period to period that match is going to help paint a better picture of where they were last year, where they are this year. Are they doing better? Are they doing worse? So the biggest question that most people ask, why the fuck is it called a balance sheet? That makes no sense. Well, it's pretty simple. It's got a balance. Literally, assets equal liabilities plus equity. The reason why this equation works is because look at it like this, right? So assets have to be paid for either by borrowing money, increasing a liability, or taking money from investors, which is going to increase equity. And now I know what you're thinking. You're just, well, can't you just pay cash for an asset? Well, yeah, that's completely true. And you can, and a lot of companies do. But the thing about that is, in terms of the balance sheet, see, cash is an asset, and so is the asset that is being bought. So there is no effect on the balance sheet because cash goes down, but another asset goes up, so the assets stay the same. Okay, so now you know that there's assets, liabilities, and equity that are reported on the balance sheet. But what exactly are these things, and how are they listed on the balance sheet? So let's go ahead and start with my favorite section. Let's go ahead and look at them assets. So within the asset segment, the assets are listed from top to bottom in terms of their liquidity, or the amount that it takes to convert that asset into cash. So assets are divided into two sections: current assets, which are the assets that can be converted into cash within a year. And then there are non-current assets, or long-term assets, that typically take more than a year or several years in order to convert to cash. The general order of assets is as follows. At the very top, you got cash and cash equivalents. Cash and cash equivalents are the most liquid assets any company has because, well, one, cash is already cash. Cash equivalents can usually be converted into cash within a few days. Maybe you might have like a bank holding the funds for approval or whatever. So next up on the assets, we got marketable securities. Marketable securities are debt and equity securities that are highly liquid. They're in highly volatile markets. So kind of like your stocks, your bonds, options, derivatives, all that kind of stuff. Up next on the balance sheet is going to be the accounts receivable. The accounts receivable are all of the credit sales from customers. So it's stuff that they bought, but they use it with credit. So the company is still expecting that money. And I'm not looking, I do have an accounting degree, and I'm not looking to get deep into accounting because, to be honest with you, accounting is boring. But it is, a lot of it goes hand in hand with finance. So just to kind of have to say it because of my own personal jurisdiction, I guess you could say. The accounts receivable account is typically reported in a net value, and that is net of allowance for doubtful accounts. See, fun little tidbit, companies understand that they're not going to receive all of their credit sales, right? People will go default on their credit. People will not pay their bills. It happens. So they estimate a certain percentage of their sales to be doubtful debts, payments that they're not going to receive. So that value gets reported into the net amount. So it's the gross amount, the entire of the accounts receivable subtracted by the allowance account. So after accounts receivable, we have inventory. Inventory, pretty simple. It's just the goods that the company has that are available for sale. And then after inventory, we have prepaid expenses. I know a lot of people get confused because like asset, expense. If you knew a little bit more on the financial statements, you'd understand expenses go on to the income statement. So what do you mean prepaid expenses on the asset? Well, I'll explain it to you. So let's say January 1st, a company prepays their entire year's rent. Let's say it was $1,000 a month. So they paid $12,000 upfront for the entire year. Rent's paid. But since February's rent isn't due till February, they can't expense February's rent in January. They have to wait till February in order to expense it. So the amount that would have been expensed actually gets created as an asset and then gets written off as an expense in the month that is it incurred. I know a lot of you are probably looking at me like, Andy, what the fuck does that even mean? I know that's some like advanced accounting stuff. I'm sorry. I I try not to, but it fucking happens. So that was the order of our current assets. So next we're going to talk about our long-term assets, or the non-current assets. So leading our non-current section is long-term investments. These are any securities that cannot be transferred into cash within a year. And these are typically dated investments, so like bonds or certificates of deposit that are more than a year. The maturity time is more than a year, then those are long-term investments, because you have to wait till maturity to cash it. If it's more than a year, then it's not current. So after long-term investments, we have fixed assets. Fixed assets, pretty simple. This includes property, plant, and equipment, basically things, tangible assets that are fixed to operations. So they typically don't move, and they're used in day-to-day operations, so they're not looked at to be sold, so they are long-term. All right, then after fixed assets, we got intangible assets. Intangible assets are assets that are non-physical, and these non-physical assets tend to protect intellectual property rights, such as patents, trademarks, copyrights, all that good stuff. With a company, one of the most popular intangible assets is goodwill. Goodwill kind of being brand loyalty. Goodwill is typically derived from the acquisition of a company. So let's say a company paid for another company for $100 million. This company was only worth on the market $80 million. So the company that paid for it overpaid $20 million. That overpayment of $20 million will be called goodwill, because that's basically the premium paid for all the customers, logos, all that stuff. So now that we got done talking about assets, the best part in life, stuff that makes you money, let's talk about the shit that sucks in life. Let's talk about liabilities. Liabilities are a company's obligations, you know, the debt that it owes someone else. And the liabilities are ordered in a similar fashion as the assets. They're not necessarily ranked in terms of liquidity, in terms of converting into cash, because you can't really convert liabilities into cash. But there are two different sections, being current and non-current or long-term liabilities. So let's talk about the current liabilities. A common current liability that you're going to see is something called the current portion of long-term debt. So that is the portion of a long-term debt note or security that is due within the next year, right? So if you have a 30-year mortgage, what is due this year is going to be classified as a current liability, because you're going to pay that within the year. But the entire mortgage is going to be a long-term liability, because the maturity date is 30 years. Another current liability that you're going to see is interest payable. That's any interest on loans or debts that are due within the year. Next up, you got wages payable. That's the compensation that we have to pay our employees for the next year. And then another thing you're going to see is accounts payable. This is similar to accounts receivable. The only thing different having an accounts payable is that you're actually the customer that owes that money to the other company. So moving on to long-term liabilities, you got long-term debt. And long-term debt, this is going to be the interest and the principals on the bonds that you issue. Then you got mortgage debt, and then a common one that you'll see but you won't really understand is this, the deferred tax liability. This is probably the most difficult section of liabilities and has a lot to do with tax. Obviously, tax is in the name, so I don't want to talk about it too much because tax gives me PTSD. But at the same time, basically through book to tax differences, there is a potential situation where a corporation or a public company could actually be set up a deferred tax liability where they did not pay the tax in the prior year and they elected to pay it some year in the future. So moving on to the last section, shareholders' equity. So shareholders' equity is the money related to a business owner or a shareholder. The equity section is commonly referred to as net assets because it equals assets minus liabilities. The main components in the equity section are going to be your retained earnings, common stock, and treasury stock. The equity section may also include two extra parts, one being accumulated other comprehensive income and the other being non-controlling interests. And as you probably can tell by the names, they were made by the conglomerate elite to sound scary and confusing, and coming from somebody that has studied that section on the CPA exam, it fucking is. Okay, not gonna talk about it. Just know that they're there. If you want to be a CPA, then you'll learn about it. So we're just gonna stick talking about retained earnings, common stock, and treasury stock. That's all you need to know. So retained earnings are the net earnings of a company. There's a few different things a company can decide to do with their retained earnings. They can, one, keep it into the company and reinvest it into the company. Basically, technology companies do this to stay on the bleeding edge. They can also use that money to pay off any debts early, or they can decide to distribute that retained earnings out to the shareholders, which is commonly known as a dividend. So next up in shareholder equity is going to be common stock. So common stock is going to show how many shares were authorized to be issued and how many shares were actually issued. And then last up on the equity section, we have treasury stock. And treasury stock is the stock that a company purchases back from its own shareholders. So basically treasury stock, companies decide to buy back their shares if they think that the stock price is going to increase sometime in the future, maybe because they know they're going to have a profitable quarter, they're going to have a profitable year, so they buy back. And that signals that management and executives have high hopes, high feelings about the company and what the company is going to be doing in the near future. So that'll drive the price up so that later on in the year, that company can then resell those shares at the increased price in order to raise more money. And treasury stock allows them to do this without having to authorize those shares to the SEC again. Once they authorize a stock offering once through the SEC, that number of shares that were authorized can be distributed or offered, should I say, to investors at any point the company feels like it. And there you have it. That's the balance sheet. Hope you enjoyed this video. I hope it helped. Please, please, please smack that like button right on the ass. And go ahead and subscribe if you're interested in more finance content. Always remember, the best time to start investing was yesterday. So go ahead and get all of the links in the description, get you some free stocks, free crypto. But other than that, I hope you have a great day and I'll catch you next time.